sort of first point to make is, when we talk about a high tax world, it's not just a question of high tax rates in a given location. I mean, there's a bunch of different dimensions to that. I think, there was a reference to the UK, and there's been a whole bunch of tax changes there. And like a lot of countries, there are revenue pressures, and there's only really two levers to increase collections or reduce spending, but there's a lot of political pressure around both. So there's lots of tough policy choices, and you can see the consequence of that, and that's true elsewhere. But that sort of also flows into administration and collection and audits, and what we've seen and continue to see is actually kind of increased use of information shared under the Common Reporting Standard, as well as other data sources which are increasingly being used by tax authorities to understand what given businesses, their owners, high net worth individuals, are focused on. So you kind of got to sort of think of it sort of in a much broader sense, and then you sort of see new taxes, but then maybe there's new rulings, new administrative approaches, where you thought you had a structure that was kind of good, then you've kind of got challenges around that, and it's not just tax. I mean, there can be related changes which do sort of have an impact on how you've thought about tax planning and structuring, be that residence for individuals or kind of approaches to business tax planning, etc. I'm sort of in Jakarta for sort of a couple of days, and one of the big kind of developments here has been the regulators kind of focus on dormant accounts, and what does that then sort of mean? And that kind of is financial regulators approach. So you kind of got related, AML, KYC type developments. So, there's an awful lot sort of happening. Equally, and I think we'll hear this, from the panel, there are invariably going to be opportunities, people looking to attract investment. I mean, even the US, you had the Trump visa and proposals around sort of, favorable sort of taxation. So when we talk about sort of governance, it's really, in the context of a business or even a sort of a family, is having a framework to, at the most basic level, being able to sort of understand and assess, risk, in terms of existing residents, structures, planning, etc. But also the opportunities and how, given the extent of the change, do you stay on top of that? And that's kind of what governance is really about, that sort of process of understanding, direction of travel, changes. To be able to sort of adapt, equally in terms of existing planning, understanding tax authority focus, what is their, approach around sort of given taxpayers, given transactions, what data sources are they now accessing? How does that sort of then impact in terms of, audits, choice of audit targets, and sort of, perceived or actual risk profiles as they're undertaken by tax authorities? What does that then mean in terms of, sort of, documentation, substance, and tax authorities are very sort of focused around sort of substance of transactions and structures these days. But all of that means a lot more needs to be done around sort of planning, around administration of structures, and it's not set and forget. It has to be sort of something that is actively sort of reviewed and focused. And so when I sort of talked about sort of governance, and which has been something that's developed a lot sort of over the past 5 to 10 years in a corporate sense and driven by regulators and tax authorities, really sort of applying those same principles in a private business context or in a family in a family context. I think you've just got to, well, I mean, first and foremost, and again, this panel will highlight this, really understanding, changes, right? I mean, what have you done? Where are those, where would trends likely impact that? Where will opportunities come up? So, I mean, it's hard to predict the future, but I mean, certainly if you look to the past, 5, 10, 15, 20 years, I mean, there's certain things that you can sort of say are going to continue to be in focus, right? I mean, substance, if you're conducting a business, where are the real activities undertaken, in terms of, sort of, residents, what are the different touch points with jurisdictions, and, can you be resident there? And, I mean, CRS is going to be extended in 18, well, within sort of, 12, 18 months to sort of, for instance, allow for broader reporting, including of all domestic tax residences. different asset classes will come into focus. I mean, I think, again, in the article, I talked about the crypto asset reporting framework. So for crypto investors who may not have had to think about common reporting standard, they do need to do that. So I think, Navale, it's really, there's invariably going to be a whole bunch of things happening at a given point in time. How do you kind of process that, shut out the noise and sort of figure out what's really relevant to where I'm at with my business or my investment? Where's that really at in terms of, where my family is, where, different jurisdictions where the kids might be based on different touch points, and having a plan around that. It's kind of, given that sort of fluidity, I think it's hard to sort of point to a given structure that's going to be bulletproof for a given period of time, as opposed to really understanding all the different things that are happening from all the different from the various jurisdictions, including a lot of those kind of represented today, and just being, clear-eyed about, what it means, and just having kind of a thoughtful, robust sort of approach to, to your thinking, to your planning, to the businesses you want to conduct, to the transactions you want to enter into, and where it is that, the family kind of wants to be based, and then ensuring kind of opportunities are taken, yet, full compliance is achieved, given, we are in a transparent world.
It's an interesting time in the US. I think probably the miss that we most often see when Americans come to Portugal and move overseas, is that in the US, Americans can have a very sort of domestic life and frame and portfolio, and they don't always have an understanding or exposure to other tax jurisdictions or other laws applying to them. So it's pretty comfortable to know what my tax situation is and know who I need involved on my team. And they take that mentality when they leave the US. And I think Americans are more often than not surprised at how extraterritorial US tax laws are, how complicated it is to mesh the US tax exposure with the local tax exposure where they're living. And I think more than anything, kind of flabbergasted that other people are not going to flag US tax issues for them or be able to highlight when there's something risky. And they're not always in the position to analyze the risk themselves. And so I think it's really important for Americans moving overseas to bring on US tax advice early at the immigration stage, at the visa stage, because even there we can have tax implications. And getting in front of a problem is, of course, easier than trying to fix it on the back end.
I want to answer it in two pieces, if that's okay. The first part, I'll comment on the trust first bit, and the second part, I'll talk about the transparency and autonomy. So in terms of trust first, I actually kind of disagree with it. It's so nuanced, right? Trust first is not a new thing, because, without betraying my age, I think it was back in 1972, an American economist, Kenneth Arrow, he won the Nobel Prize for demonstrating, among other things, that there's an element of trust in each economic transaction. So this is old news. The second point, and this is the most important point, is that global trust levels are in decline. And one could argue that they're perhaps at an all-time low. And there's a lot of material online about that. Most recently, I was on the World Economic Forum website, and I think last month, there's an article published by Ivan Shakvarun on it, and he has a lot of data, and it's really compelling. I think it makes the point. From our point of view, from a tax point of view, we're seeing that element of that low trust level when we look at the governed versus the governments. So we have the rise of supranational, with a PRA, supranational surveillance in the form of FATCA and CRS, because that's what it is. There's a lack of trust, so this is how you compensate for it. And from the micro level in individual transactions, there was, and I think Time Magazine last year, September, the title of the article was "Welcome to the Golden Age of Scams." It says what it is, right? And lots of data from the Federal Trade Commission, tens of billions, and it's going year on year, it's going up and up and up. And one of the most important points is that these numbers are probably understated, because the vast majority of people who are subject to scams, they keep quiet. So again, all-time low. Now, when it comes to our space as tax professionals, advisors, wealth management space, what we're contending with is a tax entertainment industry. I think in the article I made reference to John Anthony Castro, who was sentenced to 15 years in jail last year. I think he was in Texas in the US, and he was quite popular in YouTube, at least in a certain space, not just with US international issues, but he kind of carved a niche for himself in matches between the US and Australia. He's quite contentious. He had a lot of followers, and unfortunately, he may not have been doing the right thing. So in short, I kind of disagree with the statement. Trust has always been a thing. Right now, it's at an all-time low, and I think it has to do with being in the age of social media. So now we can have someone purporting to be a tax advisor. They may not have any qualifications, may not have finished high school. They're hiding away in some jurisdiction without any sort of oversight and regulation, and they may be in a swimsuit or in a supercar on a private jet, giving this air of affluence. And they're able to do that because of before this time where we are right now, unlike in the past, we have social media and we have influencers creating a relationship of trust with their followers. And in the tax space, unfortunately, we see that can lead to abuse. And so I think that's what kind of makes it a bigger deal than it was historically. Now, in terms of the second part of the question about transparency and without giving up autonomy, I try to tell many of my clients, those who want to listen anyway, here are 3 facts. You may not like it, but these are the 3 facts, right? The first is, to a large extent, privacy is dead. Now, I know there are some ways, yeah, but generally speaking, privacy is dead. And I'm not just talking about the information sharing frameworks like FATCA and CRS and coming up with CARF, but there have been so many leaks going back to the 1990s with the Liechtenstein leaks to recently you have Paradise Papers, Pandora Papers, Panama Papers, and so on. Not to understate the influence of whistleblowers. The most prominent, at least in our generation, has been Bradley Birkenfeld from UBS, and he brought the Swiss banking industry to their knees. So with that wave, to think that you can hide is probably not the smartest thing to do. The second fact is that governments don't like the idea of untaxed income. It's a core policy position of the OECD and lots of other multilateral institutions. I mean, that's why we have Pillar 2, which is a global minimum tax, but we also have a lot of other principles within the international tax space that arise from that. So like POEM, place of effective management, economic substance, transfer pricing, blacklist, and so on. So what we have seen is banks have become more or less agents of the tax authorities. And, you know, it is what it is. And my third point is, if it sounds too good to be true, it probably is. Come on, let's be real. So having established those 3 facts, unless you want to go with the so-called passport bros and hide off grid in an emerging market, the point is you can't avoid transparency. Transparency is here, and it is here to stay. But what you can do is have some degree of autonomy by, I advocate, cultivating some sort of a curated portfolio of residences and citizenships. So if you don't like what's going on in one particular jurisdiction, you can, you know, just hop on a plane and go to another one of your homes, and just, you know, the ebbs and flows of the election cycle will play out. And you can go back, or you can stay and you can move around. So you have autonomy to the extent that you can vote with your feet, as it were, but transparency is here to stay if you want to work within the framework of the rule of law.
I think at the outset, what is important to put front and center is just all the change that has happened in India in the last 20 or so years, right? So if you look at private clients in the country and how their priorities have changed, even just over the 2 decades that I've been in practice, it's been quite a significant and a sea change. So, 20 years back, you would meet even billionaires who didn't have wills. because they would say that, my grandparents didn't do it, my parents didn't do it, and so why should I? And so the more sophisticated questions of Dubai and Singapore and so on never really used to come up at that point because folks were simply not thinking in those terms. I think a lot of this change has happened in the last 10, 15 years or so. And within that 15-year period also there's been a slow sort of shift. So 15 years back, if you asked Indian families what their preferred jurisdiction was, both in terms of relocation but also in terms of where they would want to send money to make investments and so on, and there are regulatory considerations to being able to do that, but for both those things, in general, the pendulum would sort of tilt towards Singapore. And that was for a couple of reasons. And I'm sure Nandini will have more to say on this. But essentially, in the early 2000s, India and Singapore entered into a comprehensive trade agreement. So the activities between the two countries, increased quite a lot at that point. And also, there was a lot of the perception of Singapore in general was that of a place that was transparent, where the rule of law worked. It's a common law country, so very similar in terms of the legal regime to what India has, right? So all of these things made people quite comfortable. The distance helped. The English speaking sort of culture of business helped. So all of those were things that really made Singapore stand out. Um, I think in the last 5 or 6 years, a couple of things have happened. One is that, historically, when Dubai was brought up, at least like 10, 15 years back when it came up, there was always hesitation, right? There would be a moment's pause. So they'd be like, we know Dubai doesn't have taxes, but what if, the Shah changes his mind, or, what if locals don't accept us? All of those questions used to come up. And I think at that point, Dubai was also culturally a very different place to the place that it is now. So, for instance, I still recall when we would go there 15 years back during Ramzan, you couldn't get a bite to eat. And then they started this system where they would curtain off the restaurants. So you could get something to eat at lunch, but the restaurants would all be curtained off. But today, when you go there, it you wouldn't be able to tell the difference between Dubai and any other place in the world. And similarly, they've removed restrictions on local ownership of businesses. They've moved from a work week, that has Saturday and Sunday as holidays as compared to what they used to have earlier. They've made immigration super friendly because of the golden visa. So all of these things, I think, have really increased comfort. And on the other hand, Singapore has become quite restrictive, I think, in terms of its immigration policy. And I think it's become quite difficult for people to find a foothold over there. I remember this one case where we had a client who was from an Ivy League. He'd set up a super successful business. He wanted to relocate to Singapore and establish base there. And Singapore said that we're happy to welcome you, but they didn't give his wife a work visa. And he said, I'm not going to relocate if my wife can't work, right? And then that ended up going into a loop. And then finally he got irritated and said, I'm just going to go to Dubai. The point I'm making here is that both jurisdictions have significant benefits and they do enjoy significant comfort, at least as far as Indian families are concerned. There has been a gradual shift where I think today they're much more equal in terms of preferences than they would have been about maybe 15 years back. And whether a family chooses to go with Singapore or Dubai will really depend on what they're looking for. So Dubai, for instance, has established a reputation for being easy to do business in and sort of welcoming. Singapore, on the other hand, has a reputation for having really good, processes of governance and rule of law and things like that. Whereas I think in Dubai, that's still at a nascent stage. So it really depends on what folks are going to prioritize in terms of where they want to relocate.
I do believe it is still very underutilized. What makes Malta stand out is that it offers the trifecta of what families are looking for. That is tax efficiency, legal certainty, and actually a lifetime that works, basically a lifestyle in the sun. Other than that, we are a new country, so we get all the benefits of being a new jurisdiction. Furthermore, Malta as well, we kept the remittance-based tax systems for individual, which is now rare because a lot of jurisdictions are removing this concept. So families can plan what they do with their income and how that income is taxed. Furthermore, foreign capital gains are not taxed at all, even if they are brought to Malta. Then those add with the benefit that we are an English-speaking jurisdiction, we're EU aligned, etc., etc. We have as well a very strong structuring legislation. We can offer trusts, foundations, holding company, and we have also a very solid financial services sector. Now, in my article, I spoke a lot about the residency routes in Malta. So at the moment, we have two very strong residency routes, which is the Global Residence Program. It offers a flat rate of 15% on a foreign income remitted to Malta. And anyone that goes for this route can live on the island as long as they want and as little as they want, as long as they're not tax residents somewhere else. Then there's another one which goes one step ahead, which is the Malta Permanent Residence Program. This is a residency program, which basically can obtain by giving a one-time contribution and a property commitment. And with this, you can stay in Malta and live in Malta as long and as little as you like, and you can travel across the EU on a basically visa-free. So these two programs give the flexibility to structure the income for families. This week, there has been an update with regards to the new citizenship scheme. Now, Malta reframed their citizenship scheme as a citizenship by merit route. It is no longer a transactional path, so you don't just make a financial investment and you get the citizenship. It is more focused on merit. So those people, those families who come to Malta and can prove that they are innovators, they are entrepreneurs, or by way of philanthropy, they would be given citizenship to them and their family. So it's no longer on the investment route, it's more on what you contribute to the island. So basically, other updates that there have been in Malta in the past year is the large taxpayer office. The large taxpayer office, which is basically we made sure that these high net worth individuals who have a significant tax amount to pay in Malta, they would be streamlined and they would be treated efficiently. So it shows Malta's commitment to building real relationships with these high net worth and ultra high net worth. So I think Malta still ultimately flies a little bit under the radar. Families still opt for the jurisdictions that are more, known, like London and things like that. But I think Malta is very well structured to manage cross-border complexities, and I think it will go a very long way. So I still believe that this is still the beginning for Malta.
It's definitely one of the factors. I think, as everyone probably on this call will know, the UK, prided itself on its non-dom regime and the fact that it enticed so many wealthy individuals to move to the UK. And I guess for a long time, we had quite a lot of certainty around what that meant, broadly that your foreign income and gains weren't going to be taxed unless you brought them to the UK. And they first changed that, made a major change to that in 2017, where they restricted the number of years you could claim it for. However, I guess in the background, there are still lots of things that you could do to sort of get around it once you've been here 15 years. And then now again, with these changes coming in, only 8 years later, where we now have a completely new regime, I think people that has definitely contributed to people just thinking, okay, we don't know what's going to change next. And so is the UK the place we want to be? I suppose for those who are already in the UK, the changes have introduced quite a large tax burden upon them. And I think it's just got too high. I mean, when you look at what's happened in the UK, the top 10% of income taxpayers pay 60% of income tax receipts. Back in the 1970s, which I know everyone loves talking about, when we had super high tax rates, up to 99%, I think it was, the top 10% paid 11% of the tax take. So you can see that now the tax burden is huge for wealthy individuals. And yeah, these changes on uncertainty is kind of the nail in the coffin. I mean, with the last changes, I know it's been 8 years, but it takes a long time to sort of get your head around these changes, the nuances, even for advisors, so let alone for individuals to sort of wrap their heads around another regime is just kind of a step too far. I think it's also the kind of sentiment within the UK now, which feels quite anti-wealth. When you look at what the UK has kind of done in terms of entrepreneurs and how they're taxed, in the last 10 years, they've reduced the relief that's available when you sell your business. It used to be 10 million, now it's 1 million. They're introducing inheritance tax on businesses. And I think inheritance tax is the big one for everyone, especially the global wealth. And that saw a lot of people kind of running for the door before April, before they would potentially get caught with a 10-year tail where they're going to be subject to UK inheritance tax. I think another thing that has changed in the last sort of 5 to 10 years is the number of other jurisdictions that have introduced beneficial regimes, especially in Europe. So, previously, I suppose we've had Switzerland and Monaco for a very long time. But now you've got Portugal and Italy. And, interestingly, when Italy first introduced its regime and, clients were maybe looking to move to various places in Europe, the UK being one, Italy was always seen as somewhere that was unpredictable. Like, how long is this regime actually going to be in place? Do we trust that they're not going to keep changing it? And the irony is that that's kind of been in play for 10 years. And whilst, yes, the cost has increased, it's still pretty similar. And the UK is now that place that is like considered unpredictable. So I think, yeah, definitely we're seeing a lot of people looking to leave. That has certainly happened. On the flip side, I'd say, interestingly, the changes have been really good for British people who have lived abroad for a long time and they want to move back. Suddenly they've got lots of planning open to them that wasn't open to them before. But yeah, I think attracting wealth, there's been a big shift in those that actually want to move to the UK because of what's happened.
In my article, we created this concept called Smart Shore. And it seems to me, hearing my colleagues around the table, that we can probably achieve many of those or provide solutions to many of those obstacles that colleagues online seem to be encountering. So, for example, India going for Dubai and Singapore as the first stop traditionally. Well, Shreya, we've just also signed a big memorandum of agreement with India. And so we're getting closer and closer, even to the point where I believe we'll have direct flights from Cyprus to India and vice versa, of course, quite soon. So we had your Prime Minister visiting us. We had our President coming over to you. I sit on the Cyprus-India Business Association for some years now, and I'm very excited that we've become active, the two countries. There, of course, Anna, in the UK, mass exodus of millionaires. There's a big list of countries that they're moving to. Cyprus is included in those, by the way, Anna, because the main points that my colleagues touched upon, which is the stability, the trust, the long-term vision, all of those things we can offer here from Cyprus. I've been here for the last 30 years. I've seen it transition from an offshore center, if you like, to a very sophisticated international business center that has a great number of tax and other benefits, because we've said on this call also that it's not always purely tax driven. Nowadays, it's one of the many considerations. And so when we say the taxed generation, we're also talking about taxed in the usual sense of the word, and doesn't necessarily involve, how can I mitigate my taxes on worldwide income, which is something, of course, that Cyprus is equipped to do with its very attractive tax regime, both on a corporate level and trust level, and also we have a very nice non-dom regime that we're all busy promoting, which will allow, subject of course to fulfilling necessary requirements, a zero tax rate for the next 17 years for people taking up that non-dom. And we have a very pro-wealth government as well, who are right behind the wealthy structures that we are, or the structures that we are seeing for the wealthy coming in to Cyprus. And so whether that's a single family office or a multi-family office, as Boulder, of course, we place a great deal of emphasis on the next gen and seeing how our automated processes can satisfy their needs as well, because we all know that that's for Sasha and nearby the millennials of the world and the next gen. I think all of that is very important, because they are most certainly into remote and not necessarily owning assets and all of the administrative burden that comes with that, but understanding where it's all going in the remote space. So Cyprus offers the tax efficiency and legal strength, the strategic location, of course, EU, very important for global wealth management and indeed trading, because we're in the middle of 3 continents, so easily accessible. We're EU, we're Eurozone. And maybe this is politically incorrect to say, but I was anti-Brexit at the time, but hey, it happened. And these are the consequences, unfortunately, or fortunately, for some of us online, because we are, of course, seeing a lot of interest from all of the jurisdictions online for setting up either a single family office or a multi-family office, for all of the benefits that brings. And it doesn't necessarily follow that people have to, or our clients have to move here. With the 60-day rule, they can adopt the non-dom regime. They can, very easily benefit from all of those things. And as Derren said, remain nimble in terms of global traveling. Where do they want to be? So we have a good number of residency opportunities here that can be combined with structuring both on a personal and business level that meets a great number of objectives for the client. So always the first stop, of course, is to understand their objectives, the investment, legacy, lifestyle. What is it that they want to achieve, and then work from there. Most certainly, though, based on what I've heard during the call, if any of my colleagues or our guests online have not explored too deeply Cyprus as a potentially interesting jurisdiction for wealth planning, then of course maybe the time is right for them to do that. I'm happy to answer any inquiries following this call, of course.
I will try and structure into 3 parts. One is the human use case, right? So I deal with, so this is past tense. We're not demystifying. We have quantified using AI, we've quantified what is the tax liability. Not for all countries, but about 20 odd countries. That was tough, but we have done it. Looking at the human side of things, right? So I've got I've got around 80 nationalities, 80 countries across the world using the app. I have thousands of ultra wealthy millionaires who need to track their tax residence using the app. And just looking at some of the use cases, there's finance millionaires, hedge fund owners, hedge fund, principals from the US moving to Puerto Rico. We see that a lot. You have a lot of Russian origin entrepreneurs who've either moved to Portugal or Cyprus and Malta. And you've got all the Indians who count London as the cleanest city in India. But just scratching beneath the surface, there's a serious problem, right? These people are moving for lifestyle or business reasons, but they do take their tax history and baggage with them across time zones and tax zones. And here, this is where the app really comes in its own. So it's tracking their tax residence, but only they are able to access where they're resident. They're only able to access where they've spent time in a certain country for what purpose. So that's the core function. Then you apply tax laws of around 40 countries onto that geolocation data. You get the tax resident status. This is all proprietary data. It only stays within the app. No one else but the user knows what's going on. But then comes the problem of, okay, I'm not happy being a resident in country X. I'm thinking about moving to country Y, but is there a country Z that I should consider? And this is the power of multi-tax jurisdictional computation that we've created and delivered. So literally, you're thinking between Cyprus, Malta, and Portugal. Where do I go? How much would I be taxed as a resident? How much? What are the tax incentive schemes in these countries? The app is able to answer those two questions. And then the third question is, this is your passport. So if you're moving to these countries, what residence and citizenship law can apply to you? What scheme and incentive can apply to you? So as a result of that, the app is able to solve these fundamental, tricky questions and give a very comprehensive picture of what the right answer could be. So the app can take you 80% of the way. We believe the human in the loop is the most important part of that loop, right? So again, then the shift and the narrative comes to the tax advisor, the lawyer or the accountant to say, okay, this is what AI has calculated. We have taught the AI to understand tax brackets, different rates of taxation. We've taught it to understand dividends being taxed at rate X versus salary versus rent versus capital gains, and also inheritance tax. What does inheritance tax apply to wealth? So there's been a lot of tax knowledge that has been applied into structuring the AI's decision-making logic. They're a whole bunch of agents, a whole bunch of large language models, and collectively they've created a large reasoning model. I won't go into too much of the technology, but literally technology is enabling you to quantify the expected tax liability in about 40 different countries at 95% rate of accuracy. And that gives a very good starting point for a private wealth client or a private client who's looking to move from jurisdiction 1 to jurisdiction 2. So that to me is how we are not demystifying tax compliance. We're actually quantifying tax compliance, doing the donkey work, all the admin that is needed, and now creating a pretty comprehensive picture where you've got not just a warm client, but a hot client who now wants to get tax advice in Cyprus, in Portugal, in Hong Kong, or maybe even in Dubai, right? Along with tax advice, next step is, okay, residence and citizenship advice. So this is how we've created and closed down the loop. And that's my answer. We have quantified, not just demystified tax compliance.
Multiple factors that families would need to consider, when they are looking at either relocation or succession and legacy plans. And thanks again to Shreya for a very insightful comparative analysis of Singapore and Dubai, and a very objective one at that. Let me pick up on that. And, with this background, I'll try and cover some of the points that you raised. In my view, Singapore stands out as a very attractive destination for all global high net worth individuals and business families across the globe, and most definitely for Indian origin folks. So while political stability, solid legal and regulatory framework, very sophisticated investment products are all important, I think Singapore's real draw is the tax environment. And Nirbhay alluded to it earlier as well. And while Singapore isn't really technically or traditionally a tax haven, its tax structure is quite appealing. Capital gains and dividend income are typically tax-free for both individuals and for companies. The Monetary Authority of Singapore, which is our central bank and financial regulator, has been extremely active, particularly in the last 2 decades, and have rolled out a whole bunch of initiatives and incentives. And 2 of the very notable incentives, the tax incentives that are available to fund managers and asset managers, are what we call the 13U and the 13O tax incentives. I say they are noteworthy because they are very popular. And the 13U scheme offers a 10% concessionary tax rate on qualifying income. It allows these SFOs to maximize your returns. And the 13O, which is the offshore scheme, provides tax exemptions for qualifying offshore funds, which enables the families to manage their investments, but without local taxes on offshore income. So both these schemes have been very, meticulously tailored, and we've seen improvements over the last couple of years as well. And they are both extremely popular. Now, in addition to both these schemes, add in the estate duty exemptions and the philanthropy tax incentives that are also available for folks here in Singapore. So in my view, I think you have a winning combination. Secondly, investment opportunities. I think many of my panelists spoke about how the regulatory and the jurisdictional landscape, as well as the tax landscape in their respective regions, have evolved over a period of time. It's been the same with Singapore. The Singapore landscape today for private wealth, which includes your private bankers, your external asset managers, multifamily offices, wealth advisors, the plethora of private equity funds that have mushroomed on the ground here, offering a whole bunch of investment options. They're all very attractive. Particularly the private banks and the EAMs offer a variety of bespoke and extremely sophisticated investment as well as insurance products, which are very attractive to a whole bunch of high net worth individuals as well as families. Now, combine this with the regional opportunity that Singapore has to offer. Singapore is often seen as the gateway to Southeast Asia. And with the upcoming neighboring markets throwing up a whole bunch of investment options, particularly in the new age technology and so on, the array of investment options that are available via Singapore have also become fairly broad. And again, so combine a favorable tax environment with investment opportunities, looks like, winning formula. Now, additionally, there's blended finance and philanthropy, which is also gaining ground. We do think that a whole new segment of high net worth individuals have cropped up today. It's not just the traditional business families, the patriarchs and the matriarchs who are looking to to have second homes and have phenomenally strong legacy and succession planning, but there have been a bunch of entrepreneurs who've had very high value liquidity events. And there has also been the great wealth transfer has also started, which means that the second and third gen have started receiving wealth, just, having been born with those silver spoons. And I do think that this lends a completely different approach to wealth. How do I manage wealth? What do I do with my wealth? And it has thrown up a whole bunch of socially conscious individuals as well. So with all of this, with the single family offices, with high net worth individuals, they're increasingly looking to make a positive impact, blending wealth management with social responsibility. And I think Singapore is opening up its philanthropic initiatives and again, throwing a whole bunch of incentives there as well. So all of this, I think, contributes to making Singapore attractive, definitely for Indian origin families, but also for global high net worth individuals. Now, I would bunch all the factors that I spoke about earlier as financial considerations. And particularly for Indian origin families, and Shreya alluded to this as well. In addition to proximity to India, safety, lifestyle, and so on, there is a very strong cultural connection. The extremely vibrant Indian community is getting bigger. Familiar festivals, cuisine, all of these things go a very long way in making an adoptive place feel like home. So I do think there is an emotional angle to this as well, and which is again compelling. Now, to combine all of this, well, all of these seem like phenomenal advantages. But again, to address the second part of your question, I would say a word of caution here, because it's the legal and the structural aspects for Indian families particularly is pretty complex. And the journey starts in India. To navigate India's very complex regulatory landscape is time consuming and also takes, a whole bunch of effort. Again, it's very crucial, I would think, to be extremely well advised on cross-border tax liabilities, including capital gains and wealth tax, and also to understand the tax treaties between India and Singapore. It's extremely important until Nikhil's app comes up and AI takes over that, the tax advisors and legal advisors across both regions will have to sign off on legal implications, governance requirements, compliance obligations, and so on. So it's complex, it's complicated, and I do think with the right advice, all of this is very much possible. Yes, today Singapore does take, it's a lot more time consuming than it was a few years ago. But if you are looking at tax optimization, and with the right advice that will stand the test of tax planning in the long term, I do think that, the Singapore advantages in terms of investment landscape, cultural connections, and so on are very attractive to Indian origin families.